18 months, that's how long they have. $9 trillion in corporate debt, all of it borrowed when rates were zero, all of it coming due between now and the end of 2027, and none of it can be refinanced at terms these companies can survive. The clock started ticking in January, and most people have no idea what's coming. Let me be very clear about something. $9 trillion is not a small number. That's not a sector problem. That's not a regional issue. That's the entire corporate debt structure of the United States economy, and it's about to implode. To understand why this matters, you need to understand what happened between 2020 and 2022. The Federal Reserve dropped interest rates to zero, actually below zero in real terms when you account for inflation. The message was clear: borrow as much as you want. Money is free. And corporations listened. They borrowed heavily, aggressively, without restraint. Private equity firms loaded up on cheap debt to buy companies. Real estate developers financed massive projects at 2% interest. Retailers refinanced existing debt at record low rates. Tech startups raised billions through convertible bonds. Energy companies borrowed to fund expansion. Everyone borrowed. Because why wouldn't you? When money costs nothing, debt feels like free capital. And here's the key detail most people missed. These weren't 30-year loans. These were 3-year, 5-year, 7-year loans. Short-term debt, bridge financing. The plan was simple: borrow cheap. Grow the business. Refinance again in a few years at similarly low rates. Roll it over, extend, and pretend. Keep the game going. But something changed. Something nobody planned for. Interest rates didn't stay at zero. In March 2022, the Federal Reserve started raising rates, aggressively, the fastest hiking cycle in modern history, from 0% to 5.3% in less than 18 months, and corporate borrowing costs exploded. A company that borrowed at 2% in 2021 now faces 7.5% to refinance in 2026. Let me show you what that means in real numbers. Imagine a mid-sized company. Call them Genericorp. They borrowed $1 billion in 2021. 3-year term, 2% interest. Annual interest payment, $20 million. Manageable, profitable, no problem. Fast forward to 2024. That loan is coming due. They need to refinance. They go to the banks. The banks say, sure, we'll refinance. At 7.8%. Now do the math. Same $1 billion loan. New interest rate, 7.8%. Annual interest payment, $78 million. That's not a 50% increase. That's not double. That's nearly 4 times higher. Can Genericorp afford that? Probably not. Their profit margin was already thin. They were operating on 15% margins, $150 million in annual profit. Now $78 million goes to interest instead of $20 million. That's $58 million less in profit. Their margins just collapsed. So what do? They have 3 options. Option 1, accept the new terms and hope they can cut costs enough to survive. Option 2, sell assets to pay down debt and avoid refinancing the full amount. Option 3, default, file for bankruptcy, restructure under court protection. And here's what's terrifying. Across the entire corporate landscape, thousands of companies are facing this exact choice right now, not hypothetically. Right now, in the next 18 months, $9 trillion in corporate debt is coming due, and the vast majority of it cannot be refinanced at sustainable terms. Let me show you the timeline, because the calendar is not negotiable. 2025, $2.3 trillion in corporate debt matures. That's debt that must be repaid or refinanced this year. 2026, $3.8 trillion. The largest refinancing wave in a single year ever recorded. 2027, $2.9 trillion. Added up, $9 trillion over 3 years, all borrowed at rates between 0 and 3%, all needing to be refinanced at rates between 7 and 9%. And it's not just the interest rate that's the problem, it's the credit conditions. In 2020 and 2021, banks were desperate to lend. They had excess capital. They needed yield. They were approving loans with minimal covenants, loose terms, high leverage ratios, debt to EBITDA, multiples of 7, 8, even 10 times. It didn't matter. Money was flowing. Today, banks are tightening dramatically. Credit standards have returned to pre-COVID levels. Loan-to-value ratios are down. Covenant requirements are stricter. And banks are demanding much lower leverage multiples. So even if a company can afford the higher interest rate, the bank might say no anyway, because the risk profile has changed, because default rates are rising, because regulators are watching, because the last thing banks want is another wave of bad loans on their books. Now let me show you where this is already happening, because this isn't theoretical. This is unfolding right now. Commercial real estate, the canary in the coal mine, office buildings, shopping malls, apartment complexes financed at rock bottom rates in 2020 and 2021, now empty or half empty. Work from home gutted office demand, e-commerce destroyed retail foot traffic, and the properties are worth 30, 40, sometimes 50% less than when the loans were originated. In 2023, we saw the first wave of defaults, small regional properties. A few hundred million here, a few hundred million there. The media barely noticed. 2024, it accelerated. Brookfield Asset Management, one of the largest real estate firms in the world, walked away from $2 billion in Los Angeles office properties. Just walked away. Handed the keys to the lenders, said, "We're done. The buildings aren't worth the debt." Blackstone, the largest private equity real estate investor on earth, stopped redemptions on their real estate investment trust. Translation, people wanted their money back. Blackstone said no, because if they sold properties to raise cash, they'd have to sell at massive losses. So they froze withdrawals, locked the exits, and that was just the beginning. In 2025, the wave is building. According to Mortgage Bankers Association data, over $500 billion in commercial real estate loans mature this year. $500 billion. And the refinancing rate is below 30%. 70% can't refinance. 70%. What happens to those properties? Default, foreclosure, banks take possession. Banks don't want to own buildings. They're not landlords. They're lenders. So they sell at distressed prices, which drives down valuations across the entire sector, which makes other loans underwater, which triggers more defaults. This is called a doom loop, and commercial real estate is deep in it. But here's the thing nobody's talking about. Commercial real estate is only 1.4 trillion of the 9 trillion problem. It's the most visible, but it's not the biggest. The biggest chunk is corporate bonds, 4.6 trillion in investment grade and high yield corporate bonds maturing by 2027. Investment grade means companies with supposedly strong credit. High yield means junk bonds, risky companies that pay higher interest because they're more likely to default. In 2020 and 2021, the junk bond market exploded. Companies that had no business borrowing billions did exactly that, because investors were desperate for yield, because rates were zero, because risk didn't seem to matter. Now those bonds are coming due. And the companies that issued them can't pay them back, and they can't refinance them, because nobody wants to lend to a junk-rated company at 15% interest when the economy is slowing and default risk is rising. Let me give you a real example. Bed Bath & Beyond. They borrowed heavily in 2020, issued bonds to stay afloat during COVID. The bonds came due in 2023. They couldn't refinance. They filed for bankruptcy in April 2023, wiped out. Rite, same story, debt heavy. Borrowed at low rates, couldn't refinance. Bankruptcy. October 2023, WeWork, the poster child of cheap money access, borrowed billions. Valuation hit $47 billion at its peak. Filed for bankruptcy November 2023. Debt they couldn't service. Refinancing terms they couldn't meet. These aren't small companies. These were household names. Brands everyone knew, and they're gone. Now multiply that by 1,000, because the debt maturity wall is just starting. Let me show you the sectors at highest risk, because this isn't evenly distributed. Some industries are fine, others are catastrophic. Sector 1, retail, already struggling with e-commerce competition, already dealing with declining foot traffic, now facing refinancing costs that are triple what they budgeted. Expect mass closures, expect household names to disappear, expect malls to become even more empty. Sector 2, energy. Oil and gas companies borrowed heavily when prices were high, then prices crashed, then rates spiked. Now they're trapped. High debt, lower revenue, unsustainable interest costs. Smaller energy firms will consolidate or collapse. Sector 3, leveraged buyouts. Private equity firms buy companies using massive debt. The company, not the PE firm, carries the debt. In 2020 and 2021, PE firms went on a buying spree. Hundreds of billions in leveraged buyouts. Now those portfolio companies need to refinance, and they can't. PE firms will have to inject fresh capital, sell assets, or let companies default. Many will choose default. Sector 4, technology, specifically unprofitable tech. Startups that raised hundreds of millions through convertible debt. The idea was grow fast, go public, convert debt to equity, everyone wins. But IPO markets are frozen, and the debt is coming due, and there's no equity conversion if there's no public offering. Mass layoffs, mass shutdowns. The startup graveyard is about to get very crowded. In Sector 5, speculative real estate, not just commercial, residential developments, luxury condo projects, hospitality, all financed with cheap debt, all facing a market where buyers have disappeared and interest rates make new sales impossible. Half-finished buildings, abandoned projects, lenders stuck with worthless collateral. Now, here's where it gets systemic, because when companies default, it doesn't just hurt the company, it hurts the lenders. Banks hold these loans on their balance sheets. When a company defaults, the bank takes a loss, a big loss. If enough companies default, the bank's capital gets wiped out. And if the bank's capital falls below regulatory minimums, the bank fails. We saw this in March 2023. Silicon Valley Bank, Signature Bank, First Republic, they didn't fail because of bad loans. They failed because rising rates destroyed the value of their bond portfolios. But the mechanism is the same. Asset values fall, capital evaporates, bank fails. Now imagine that happening across the entire banking system, not just regional banks, major institutions, because $9 trillion in corporate defaults doesn't stay contained. It spreads. And here's the nightmare scenario. The Federal Reserve is trapped. If the Fed cuts rates to help companies refinance, they risk reigniting inflation. Inflation is still above target. Core inflation is sticky. Cutting rates now would send the wrong signal. Prices would spike again. And then they'd be forced to raise rates even higher later. But if they keep rates high, the corporate defaults accelerate. Companies can't refinance. Bankruptcies surge. Unemployment spikes. The economy crashes. There's no good option. Cut rates, inflation spirals. Keep rates high, economy collapses. This is the definition of a policy trap, and the Fed knows it. In December 2025, Jerome Powell was asked directly about corporate refinancing risk. His response was careful, diplomatic, but the message was clear. We are monitoring credit conditions closely. Translation, we see the problem. Translation, we don't have a solution. Now let me show you what happens when this breaks, because history gives us the playbook. 2008, Lehman Brothers, Bear Stearns, the financial crisis. It started with subprime mortgages. Homeowners couldn't pay. Mortgages defaulted. Mortgage-backed securities collapsed. Banks holding those securities failed. Credit markets froze. The entire system seized up. The corporate debt crisis will follow the same pattern. Companies default. Corporate bonds collapse. Banks holding those bonds take losses. Credit markets freeze. Nobody can borrow. Businesses that need short-term financing to operate can't get it. Payrolls get missed. Suppliers don't get paid. The real economy grinds to a halt. And unlike 2008, the government's ability to respond is limited. In 2008, the federal debt was $10 trillion. Manageable. The government could borrow trillions to bail out the banks. The Fed could print trillions to buy toxic assets. It worked? Barely, but it worked. Today, federal debt is $36 trillion. The deficit is $2 trillion per year. Interest payments are over $1 trillion annually. There's no room for another multi-trillion-dollar bailout. The government is already broke. And the Fed's balance sheet is still $7 trillion. They never fully unwound the COVID money printing. They can't print another $5 trillion without destroying the dollar's credibility entirely. So when the corporate debt crisis hits, the tools that worked in 2008 won't be available. The bailout option is gone. The money printing option is constrained. The only option left is collapse and restructuring. Now let me address the optimistic view, because I know what some people are thinking. Companies will adapt. They'll cut costs. They'll renegotiate terms. The market will find a solution. Sure, some companies will survive. The strongest ones, the ones with pricing power, the ones with low debt, the ones with sticky revenue, they'll make it. But the majority won't, because cutting costs only goes so far. You can fire half your workforce. You can close unprofitable locations. You can slash capital expenditures. But if your interest expense quadrupled and your revenue is flat or declining, the math doesn't work. No amount of cost cutting saves you. In renegotiating terms, banks aren't stupid. They know when a company is in trouble. They're not going to extend favorable terms to a borrower who's circling the drain. They'll demand collateral. They'll demand personal guarantees. They'll demand equity stakes. And if the company can't provide that, the bank says, no, game over. Second, check your employer's debt levels. Public companies disclose this. If your company has high debt-to-equity ratios and low cash flow, start looking for alternatives. Don't wait until layoffs are announced. Third, avoid sectors at highest risk. Retail, unprofitable tech, over-leveraged real estate, energy. These are danger zones. Fourth, build cash reserves. I know cash loses value to inflation. But in a credit crisis, liquidity is king. When assets go on sale, you want cash to buy. And fifth, pay attention. This story will unfold in stages. The first defaults will be dismissed as isolated incidents, then sector-specific problems, then systemic risk. By the time the mainstream admits it's a crisis, it's too late to act. The corporate debt refinancing crisis is not a prediction. It's a mathematical certainty. The debt exists. The maturity dates are set. The interest rates are known. The only variable is timing, and the clock is ticking. 18 months, $9 trillion, thousands of companies, one unavoidable outcome. The warning signs are here. The insiders are preparing. The question is whether you'll see it coming, or whether you'll be asking, like millions before you, how did I miss all the signs when they were right there in front of me? The refinancing wall is coming. The defaults are starting. The cascade is building, and time is running out. The market will find a solution. The solution is bankruptcy. The solution is default. The solution is liquidation. That's how markets clear bad debt. Not through gentle negotiation, through destruction. So here's the timeline. Here's what's coming. 2025, $2.3 trillion in debt matures. We're already seeing defaults accelerate. Small companies first, then mid-sized firms. The media will call it sector-specific. They'll say it's contained. It's not. Late 2025, early 2026, the first major corporate collapse, a Fortune 500 name, household brand, bankruptcy filing sends shockwaves through credit markets. Bond yields spike. Credit spreads widen. Investors panic. Mid-2026. The refinancing wall hits peak. $3.8 trillion coming due in 1 year. Banks can't handle the volume. Refinancing requests get denied en masse. Default wave begins. Late 2026. Credit markets freeze. Nobody wants to lend. Nobody wants to hold corporate bonds. Mutual funds holding bond portfolios see mass redemptions. They're forced to sell at fire sale prices. Prices collapse. Yields explode. The doom loop accelerates. 2027. Full systemic crisis. Bank failures. Government intervention. Emergency Fed programs. But too late. The damage is done. Unemployment spikes to double digits. Not because of a recession. Because companies literally can't operate. They can't borrow. They can't refinance. They can't pay suppliers. They shut down. Mass layoffs. And here's the part that affects you directly. If you have money in corporate bond funds, you're exposed. If your retirement account holds high yield bonds, you're exposed. If you work for a company with high debt levels, you're exposed. If your pension fund invested in private equity, you're exposed. This isn't distant. This isn't abstract. This is 18 months away. So what do? First, check your portfolio. If you hold bond funds, look at the credit quality. If it's investment grade corporate bonds, you're probably okay. If it's high yield, junk bonds, get out. Now, before the wave hits,